All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA registered, SIPC insured US based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted and get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description.
Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall. I'm not wearing headphones. I'm mad about it. Don't ask me. I'm going to answer your questions. I got Jeff Santoro here with me as usual to help answer those questions, the voice of the people. Hey Jeff.
So just to bring people in behind the scenes a little bit, Jason was just very angry that he couldn't get his headphones to work the way he wanted to.
No. You don't
I had to talk him down. He was very upset.
Get them to work. Get them to work appropriately and properly. It's not as I want them to, as they should.
Yeah. Regardless, he was a little cranky, but I think he's starting to come around. This mailbag will make him feel better.
Maybe so. I'm a little disappointed though, Jeff. You missed the opportunity to say, "Okay, boomer." You just missed it. Right there.
I did. I'm sorry. I'm sorry to our listeners because I
Don't
never like to
apologize to them.
I never like to pass up an opportunity to bust your chops in any manner.
I know. It's everybody that's been a long-term listener to this show knows our vibe, and that you missed an opportunity there. So yeah.
I'll do better. I'll do better next time.
Be better, do better. All
Yes.
right. Well, you know who did better and is being better? Our listeners, Jeff. They got us some great questions for the mailbag.
They did. They've been coming in over the past little more than a month because, as you will see from the episode title, this is the March mailbag in April. Because we didn't realize until this week that this episode would actually go out in April. So a little bit more behind the scenes for our listeners.
The full name,
we're not great at this.
The full name of the episode is the March 2025 mailbag in April because of February.
Yeah, Jason wants to blame February that we got all messed up. I think we're just not very good at our job.
Well, so obviously, like every mediocre craftsman, I'm going to blame my tools. So yeah. So
you know who I blame? Our producer.
There. Now you're thinking.
Yeah.
Now you're thinking.
I wasn't going to throw our producer under the bus, but really, it's the producer's job to keep us on schedule. So
that's true. They should definitely do better. Yep.
All right. This has gotten silly. Let's dive in and answer some questions here. These are all the questions we received since our last mailbag, which was in February. Let's dive in. First question here, Jason, comes from Mark Murray, who says, I wonder if you guys could talk about a component of portfolio management. Specifically, the thing that throws me off is this talk about cost basis and making a certain position X amount of my cost basis, as an example, 2 to 5%. This is usually followed up by talk that discusses that the position has grown to become X, which is now X amount of my portfolio. Usually, let's hope a higher number. If a stock I bought in 2020 and was 2% of my cost basis then has grown to become 10%, this should mean the portfolio has grown as well. But that also means that the same 2% position I bought today would be a larger starting dollar amount. What do you both think is the most appropriate way to track these changes, knowing that hopefully your portfolio is going up, but then also accounting for adding money to your portfolio over time as a net contributor? I love this question for so many reasons.
This is the end of our questions for today. We're going to spend 45 minutes talking about this question.
Well, yeah, I was just going to say, because I struggled with this so much. I spent so much time thinking about this when I was a newer investor. And then I just kind of stopped thinking about it for some reason, which I'll talk about as we answer it. I'll start by saying this. One of the things that I struggled with, and I think this is where Mark's question is coming from, is you hear people say position size. This position is this percent of my portfolio. And most people are not clear what they mean, whether they mean by cost basis, meaning like I've put $1,000 in this stock and my portfolio is $10,000 of my money that I put in, right? Or if they just mean current market value. And if you are a long-term investor and or a successful or unsuccessful investor, the amount you put in and the amount it's worth could be very different. So that's like level one of confusion to me is when people say position size or this percent of their portfolio, they don't usually specify if they're talking about by cost basis or by current market value. So that's like step one. Step two is the whole idea of a full position, or I start with a third of position, or I start with a half position is very confusing because that's a different thing for everyone.
Right.
And it depends if you have a portfolio that is all stocks or if it's a portfolio of stocks and other things. So I think we can both talk through how we think of this because we have very different portfolios that are constructed very differently in terms of what's in them. Like I have winning stocks and you don't. So like that's the other layer of this. And then the final thing is just that
started buying stocks in 2020.
In 2021, I was a stock market genius. I don't know if you knew that about me. Everything I bought went up.
You and everybody else, pal.
And the last thing I would say is then there's the whole individualized view of this, right? What do you think a full position is?
Right.
Anyway, those are my initial thoughts. Go ahead, dive in.
I think the key behind any of these ideas is understanding what they mean and then using them however works to help you deliver better investing returns within the frameworks of all of your goals and the things that you're trying to solve for too. So here's how I think about it. So we'll start with the cost basis part of it. So cost basis is simply the percentage of your portfolio value, the value as a percentage basis generally of your portfolio in the dollars that you have invested. So let's say you've been investing for 20 years and you've invested $500,000 over that 20 years. Let's say you've invested $500,000. That's how much money you have put in. That's your cost basis for your portfolio. And then there's the value of the portfolio. Let's say it's worth $1.5 million again, over a 20-year period. Right? So that's cost basis versus market value. Now, within those things, you start slicing it up by the individual positions that you own. And again, there's different schools of thought, as Mark alluded to here, with the idea of a cost basis somewhere between 2 and 5%. And generally, I think of that as a percentage of my cost basis. Some people think about it as a percentage of the total portfolio. Both are valid. Mm-hmm. You just need to use it within the context of what does it mean to you and whether it makes sense. And what I think, the way I think about it is as a percentage of my cost basis, not as a percentage of my portfolio. So again, I'm going to use a small round number. Well, small is contextual, but over the term of an investing career, let's say $100,000 is your cost basis. So 1% of that is $1,000. If I want to open a position in a stock and I have $99,000 invested, and this is going to be the $100,000 that I invest, and I buy $1,000 of that stock, I have opened a 1% cost basis in that stock. Okay. Now, here's the idea behind measuring this and why it's important. The reason that I use it is it's a way to keep myself in check without creating too much exposure to certain companies or ideas. And also checking against the things that I don't know, right? The things that are unknowable in some cases. So for me, typically about 2% of my cost basis is about the most that I want to invest in a company. And they almost all, well, so far in my career, every investment that I've ever made in a company has started off much smaller. So this is where you can get to like thirds or fifths or however you want to start dividing that up. The idea is simply you start with a position in the company and then you increase it over time. There's two reasons that I do that. Number one, I'm still in the net contributing portion of my investing life. I've talked a lot over the past year or so, Jeff, about the fact that we're further along in our financial goals as a family than I expect that we would be. But my wife and I are still net contributing pretty substantial portion of our income and a portion of the cost basis of our portfolio every year. We're adding a pretty sizable amount of money as a percentage of our portfolio. So because of that reality, I have long-term winners that I've bought 10 or 15 times that I'm always adding.
Because they might have been 2% 10 years ago.
Yeah. Right. Exactly. So going back to that, my portfolio is $99,000 and I buy $1,000 of this company for the first time. I now have a $100,000 portfolio cost basis and 1% in that one stock. Yeah. A decade from now, ideally, that portfolio would be 300,000, or how, you get the point, would be larger. So the only way to keep that individual stock 1% of that cost basis is to buy more of it over time, right? So it's a good way to look at your portfolio, and sometimes to look past how much a stock has gone up in percentages and look back at how much have you actually invested in it and realize, hey, you know what? This company still has a long runway. I've only really risked 1% of my capital. Or at this point, it's 0.5% of my capital, because 10 years ago, I bought a little bit and I bought a little bit more, but I haven't added to it. And it can help me, like it helps me, and I think it helps other investors kind of get through some of those like mental walls around buying more of your winners. Yeah. It's like, wow, I've hardly bought any of this big winner, and I need to buy more, right? But the other side of that too is, for example, the Brookfield entities. There's 4 or 5 of them, really 5 of them that I like a lot, 4 that I like very much, and 5 that I like a pretty large amount. And it'd be pretty easy just to buy a couple percent in each and not think about it. Like, I don't have a lot of exposure. But then you start looking at each of these entities, it's like, wow, I've got a lot of exposure to this corporate family. It's a good way to measure your exposure to trends or industries that have a lot of things that are interlinked. The risks are interlinked to help reduce your exposure. But again, I like to think about that as the cost. That's exactly that. That's what I'm putting into it. How much of my money am I willing to risk in these stocks? And then you get to portfolio sizing, which is the percentage of the market value of the company today. Is it against your portfolio, or bonds, or cash, or whatever? Whenever I say so-and-so company's 5% of my portfolio, or I've got 5% of my portfolio in cash, or whatever those numbers, that's the market value, right? That's not cost basis. So that's, yeah. And again, I use them in ways to measure, again, to help manage risk, and also help me look for opportunities to invest more money that I might be overlooking. And then when I look at things as a percentage of my portfolio, I'm kind of doing the same thing, but just in a little bit of an inverted way.
Yeah. And I like, part of what you said got me thinking about something that I had to start to think about. As you get older and invest for longer, the amount of money in your portfolio, and this is a thing I've always felt really weird about talking about, because I don't like, if you're going to retire on your investment portfolio successfully, it's going to be millions of dollars. Like, that's just the math, right? Unless you're going to work until you're 80, right?
Or
like,
you were a teacher in New Jersey and an administrator, and you have a good pension too.
That's right. Putting myself out of the equation here, no pension, right? If you're living entirely on invested wealth,
that's that shot, by the way, Jeff. That's for my friend Jed, by the way. Yeah, you're welcome, Jed.
You need to have a lot of money. So as you get closer to that goal, you have to start thinking in percentages of your invested wealth. Otherwise, you'll scare yourself out of investing the right amount of money, if that makes sense. I will spend too long worrying about if I should buy more socks, which will cost me $20, versus like buying more of a stock that I want to buy. It's just like the mental thing of like my day-to-day cash flow amounts of money that are a lot versus what's a lot in my invested portfolio. So that's why I like the percentages. And yeah, it should change over time, right? If I thought this way when I was 25, 1% of that portfolio would be now an amount of money that where I'd be like, well, I'm not even really moving the needle here, right? Like if I bought a 1% position from when I was 25 years old today and it 10x'd, that's nice, but that's not going to change my financial situation, right? Because the portfolio has grown and I'm contributing more over time. So that's like the first part about what you said that got me thinking. But again, going back to Mark's question, he says if a stock I bought in 2020 and was then 2% of my position has grown to become 10%, that means the portfolio has grown as well. Yes. And that's the second part of this that I think this is why I stopped thinking about and worrying so much about like how much I want to consider to be a full position, because the reality is, if I bought 2% of my cost basis in an individual stock and it 100x's, that is now an amount of money that I may not want to add any more to it, even if I decided, okay, 3% is now my full position amount, right? Because it has grown. And maybe it's too big of a portion of my portfolio and I'm losing sleep over it. And I actually think I should trim it. So like you do have to kind of look at both of those things. And I guess the last thing I'd say is you have to also understand the math of it, right? If you want everything to be a 2% cost basis position, you're limiting yourself to 50 stocks if your entire portfolio is stocks, because That's the math, right? And you can, so over time,
Just for those that question Jeff on that, the guy who's regularly said he's not good at math,
I'm terrible at math. Did I do it right?
the math checks out.
Okay, thank you. I appreciate
Seems to check out.
But that's the other side of it too. Like if you want to have 80 stocks or 60 stocks, like everything can't be a 2% cost basis position, right? So that's the other kind of piece of it. I used to shoot for 1% as like a cost basis goal in my portfolio, but because so much of my portfolio is not individual stocks, it took me a while to get to that, even though like as a portion of my stock portfolio, some of them were pretty large positions. And I just kind of wanted to get to that point with a few of them first, just to see, is this the right amount? And now I'm like, yeah, I could actually add to some of these if I feel like the time is right. So I've become way less concerned about it. And I think it's because my stocks are a small part of my overall portfolio.
Yeah.
But I think over time, I don't know that I would limit myself necessarily to a percentage until I get to that point where I'm like, yeah, this is enough. I don't know. I kind of feel like I'll know it's enough when it's enough in terms of how much more I want to add to any individual position.
Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brett.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
Yeah, no, I think that's right. I think that's right because I have a few that are that I've invested more than 3% of my capital into, more of my cost basis. There's not very many, and I have very, very high conviction in them. And I also know that 3% today is going to be smaller in 2 or 5 or 10 years from now as I invest more capital in other companies. So I think that's a really important part I want to finish on is that where you are in your stage of life vastly affects what these numbers probably should mean, right? If you're 25 or 35 even, and an individual company, you've invested 20% of your cost basis into it, unless you came into a windfall of money young and it's a sizable amount of money, where you are on your continuum as an investor, you're just going to invest into other stuff to reduce your leverage exposure to that individual company on the cost basis side. On the market value side, the same thing is going to happen. And what I tend to do, and I want to give Tom Gardner, Motley Fool CEO, co-founder, credit for planting the seeds in my brain to think about it with large companies, because I did make the mistake in my early and mid 30s, where I would sell off stocks that had done really well. I'd sell half of them off because it became a large percentage of my portfolio. But I was being very unthinking in doing it, because even at 35, I'm still going to be contributing for probably 25 to 30 more years, unless I just get pretty fortunate and things go really, really well, and I'm still contributing for another 15 years, right? So instead of selling half of a business basically you're punishing yourself by selling a stock that did exactly what you bought it to do, when time should help be able to solve that. But I do think that there is a point when the size of your portfolio, the wealth that you've created, the investing wealth, gets to a certain critical mass where if you do have individual holdings that represent, and this is what Tom, the seeds that he planted, at some point, an individual investment, if you're fortunate, becomes such a meaningful amount of your net worth that the downside risk is a bigger threat to your life and your lifestyle than any upside you could possibly get.
Mm-hmm.
So even selling a wonderful business that could still continue to do better than the market may be the right thing to do. Again, just even if it's selling a portion of it, because of the downside risk of you actually own General Electric and it's 2000, right? Or we could name a litany of other companies. We could say Disney 5 or 6 years ago. Anybody that owned Disney, and it had been such a wonderful winner for the 20 years before that, the past 5 years have undermined a massive amount of that. And it's still a pretty good company. So somebody that had 15% of their net worth in Disney stock and retired in 2018, it's been painful. You have to manage the downside risks at some point with these as well. But those are decisions you only make when you've accumulated a pretty sizable amount of wealth before the downsides are really, really there.
Yeah. Yeah. And everyone's got to kind of think through these things on their own, but I appreciate the question because there was no one to kind of have this conversation with when I was struggling with this early on until I started a podcast, and then I could talk about it whenever I wanted. Fortunately, I was talking about it with you. All right. Next question.
I know. Well, there's other people that hear it too, and they can give you better thoughts than me.
Next question from Jesse, who says, I would like to hear your thoughts / process for when there is an opportunity to put your cash to work and deciding whether that money should go towards adding to your winners versus making a bet in a new company that you found strong conviction in. And how do you think your leaning towards either of those options changes as your overall portfolio develops over time? Jesse then goes on to say, and by the way, this is the best way to get your question answered on our show. Keep up the good work, bringing great content to the pod, but maybe try a little harder on your picks for the stock contest. The last time I looked, I was smoking you both. Here's to no whammies, and that's still being the case if you use this in a future episode. So Jesse, I checked, and as of today, March 25th, after the market close, Jesse's portfolio is up 8.6%. Now, that's pretty good because the market, I believe, is still down on the year. And I am up currently 1.7%, and Jason is up 1%. So Jason's in third place out of the three of us, Jesse. But yes, you are thumping us as of today. So congratulations. We'll see how the rest of the year shakes out. But busting our chops is, I mean, you're automatically on the pod if you do that. So good job, Jesse. All right, let's answer his question, though. How do you think about adding to your winners or making a bet in a new company that you have strong conviction in?
This is a great question because I think this is a common struggle. Struggle might be too strong of a word, but a high quality problem maybe is a better way to think about it that we do face as individual investors picking stocks. And I think it's a little cyclical to a certain extent because we do go through, and the past few years, we've had numerous opportunities. In 2020, we saw almost 35% drawdown. 2022, we saw a 20+% drawdown. We just hit 10% drawdown here recently. So now I just said that we've had a lot of opportunities, but what we've had is a pretty normal range of opportunities if we look at the market's history.
Right. We had an average 3 years as it pertains to that kind of stuff.
Yeah. No, exactly. But even if you look at the February 21st, I think it was 2020, that was the peak before the market crash through now. Like that was the worst time to buy for months. Time has shown that winning businesses continue to win. You can look at the Magnificent Seven, and sure, with all of them, you could say there's a little bit of a hype there and some high valuations for most of them, largely tied to AI, except for Alphabet, which is some of the cheapest valuation multiples we've seen in many, many years. What have they done? The companies have won. The businesses have won. And therefore, over that 5-year period, the stocks have moved up and beaten the market because they've grown their earnings per share broadly enough to generate market-beating returns. So I think it's a little bit of both. Because I think the biggest mistake most investors make is a bit of a version of the Peter Lynch quote that, to paraphrase, that more money has been lost by investors sitting on the sidelines than waiting for the next downturn. Because the market moves up so much before we do see these downturns, is that opportunity cost he was kind of hinting at. And I think it's the same thing. The hardest thing to do is find a great stock, right? It's not the hardest thing to do. It's one of the hardest things to do. It's the second hardest. The hardest is to hold it, right? The third hardest is to buy more of it on the way up, because we continue to anchor on the previous price, and we anchor on the try to buy the dips and looking for opportunities, and we water our weeds and trim our flowers, as the saying goes. So I do think that there's nothing wrong with looking for opportunities to buy on the dips, especially like with cyclical companies. And we go through periods like we are now where the market is still down. There are opportunities to buy great companies that are down more just because the market's down, right? So seizing those opportunities when they happen, but more investors should be regularly taking the advice of the next stock to buy, maybe one you already own in a lot of cases. Because if you've already found a winning stock, that's the hardest work. Buying more of that winning stock is almost always a perfectly good place to go with your money.
Yeah. So I agree with the adding to the winners part. That's half the question here. I think the hard part for me, and I think this is what Jesse's also driving at, is like, let's say you've established that you're able to bring yourself to add to your winners. When do you do that versus adding a new company, right? Like you come on a new idea, you're excited about it, you think it is the next big thing, but you also want to add to, let's just use Google because we already talked about it. You want to add to Alphabet because it's a winner and it's a good opportunity value-wise, right? Like, how do you handle that aspect of it? Because I've changed very much my strategy of adding new companies over my time as an investor. But I'm curious, like, when it's the day you've decided to buy something, how do you think through like adding to what you already have versus, oh, here's a new idea I want in my portfolio?
So I've slowed my process down, but I've never been one to hesitate to add a new company to my portfolio. But sometimes I think there's a little bit of a misconception of what that means. If you look at my top 20 stocks or my top 10 stocks, that's at least a third of my portfolio. If you look at the top 20 stocks, it's probably 70% of my portfolio, right? So it gets pretty concentrated. And the reason why that's the case is a lot of those kind of almost like venture capital approach, leaning out on the risk curve stocks that I've bought, I've taken really small positions. And I haven't added to them because they've been dogs. The stock, but also the business. The business hasn't earned any more of my capital because the business didn't win. They didn't grow revenue. They didn't start creating operating leverage and getting better margins and moving to profitability. Or in a few cases, I paid too much the first time. And for one reason or another, maybe I haven't started adding to. But a lot of them I do hold to let things play out. Sometimes it takes years for these stories to play out. So I'm glacial about selling. And sometimes companies do figure it out, just a few years later than you thought, or you were dumb and that initial position that you took was just at way too stretched of a valuation. But the opportunity to invest is going to come back around. So the difference for me is that while I may start that position, it's almost always going to be a lot smaller. Mm-hmm. And I'm always going to be in a position to spend more money on a company that I know, that has a business that I know can deliver results. And then lastly, has a management team that's not going to it up.
Well, and I think the difference between you and me, at least, is that you always have a decent amount of cash in your portfolio. So if I'm just picking a random number for an example, but let's say when you buy a stock that you have conviction in, let's just say that that's $1,000, right? Just to pick a round number. You have cash, so you might still buy the thing you have high conviction in that's in your portfolio and spend that 1,000 there, but then you might take a couple hundred additional and pick up that starter position.
Yeah, and I think that's exactly right. If I have multiple ideas today that look attractive today, I will buy today. I don't sit back and wait because I keep more cash. And also because unlike most of the people out there, Jeff, yourself included, the majority of the money that your contributions, they're going into a retirement account through your employer. So me, because I'm a solo contractor, I have a solo 401k. So I have complete control over all of that liquidity, which means I have more capital to work with every pay period to be able to invest. But yes, I also do keep more cash. Writ large, I keep more cash.
And that's why I don't do it the way you do, because here's what I used to do. I used to take the amount that hit my account every 2 weeks, right? The amount that I was allocating to buying stocks with, which is just a percentage of my income. And I would take, again, let's just pick a round number. Let's say that's $1,000. I would take that $1,000 and I would buy 5 things, right? I would take it and split it into 5 and buy tiny little bits of everything. And then there are some companies, like the oldest ones in my portfolio. If I go look at all my positions, like all the times I bought it, there might be 30 individual buys, but some of them are $100, $50, because I was, and what happened was my portfolio ballooned to 120 stocks. It was too many. I couldn't keep track. And even when I did come across a winner, I didn't know enough about the company to know to add to it, and then I'd have something I put $100 in that quintupled. And I'm like, oh, that's nice. But again, my portfolio 25 years into being an investor is large enough that that didn't make a big difference. So I pivoted to taking larger bets less frequently so that when I'm right, it's more substantial. Because again, with this being such a small part of my overall portfolio, I felt like I could take some bigger swings. But so what I do because I struggle with this a lot, like when it's the day I'm sitting down to buy something, do I add to something in my portfolio or do I add a new stock? 2 things that have changed for me. I'm very slow to add a new company, just generally, because I'm super picky now. I really want to make sure I have a decent amount of conviction, even to take the small starter position.
I think that's smart, Jeff, because again, you have a full-time job. Again, like most of the people listening here, my full-time job is investing. And because of that, I have far more capacity to follow companies. And I think one of the mistakes that people make along the way is buying a stock that they don't have the capacity or interest in following and learning about. And if you don't have the capacity to have some understanding of what you're owning, you're either going to miss opportunities to add to it, or you're going to not know what to do when the stock falls, whether or not the business is deserved being sold or being bought, and you're going to make a mistake one way or the other.
So I'm a little more vibes based when it comes to adding a new stock. It's usually I get excited about an idea, and if I'm thinking about it for a couple weeks or maybe even a month or two, I'll eventually just buy it. There'll just be one day I decide that today the thing I buy is this new thing. But that happens maybe 3 times a year now. That's how much it has slowed. Whereas I think I went from 0 to 120 stocks in 3 months when I started as an investor. Everything was new and shiny to me and I just wanted it. But so I think the answer to the question being asked here, it really boils down to what kind of investor do you want to be? If you want to be a buy 100, buy 200 stocks and just add to the winners kind of that, if that's your vibe, then maybe you're going to lean more towards adding new stuff versus adding to your winners, at least until you decide to change that strategy. For me, I would say I'm almost always adding to a winner, and it's only a few times a year I'm putting a new company into my portfolio. I'm at the point now where I have 42 stocks, maybe a little less because a couple of those are ones I own simply because they're in that portfolio we did for my dad a couple of years ago, Nick's Picks. So I don't really count them as my positions really. And I have a couple options positions. So I guess probably, and there's some I just won't add to right now, no matter what, like Outset Medical. So there's probably more like 35 companies that I would say I would consider to be actual positions in my portfolio. But still, that's the borderline of me. That's the borderline amount I can keep up with. So I'm just slow to add. And I think the last thing I'll say, I like the concept of if you're going to add something to your position, you should sort of have to decide what it's better than, right? If this is a better idea than my lowest conviction stock, maybe I should just swap them out. I like that idea theoretically. I've just not been able to be that disciplined.
Yeah, that's the key. It takes a lot of discipline, and you have to understand what you own, because a lot of times the tail wags the dog, and your conviction is tied to whether it's made you money or not.
Right. So my conviction means what's down the most.
Yeah. Yeah.
Which is not always the best way.
That's exactly right. And I'll tell you, I've been on this home builder kick lately. Last week's episode was on home builders. On the live stream that I'd spent a lot of time on for Motley Fool members, I've talked a ton about home builders. But this is a perfect example of 2013. I bought Meritage Homes for the first time. If I had not have spent months and months after that really learning the industry, everything that I thought I understood, trying to confirm it and disprove things, I would have missed the wonderful opportunity in 2015 or 2016 when the entire industry was down and the stock was down 40 or 50% from what I paid in 2016. I would have sold that loser and moved on. Instead, I knew what was going on and I bought more in 2015, 2016, and early 2017. And those investments have more than doubled the S&P over that period. It sounds like I'm bragging, but one simple thing that I took the most important thing that we skip, and that's learning about our businesses. If I hadn't have done that, I would have far less accumulated wealth to show for it, just because of that one decision about that one industry.
Yeah.
Hey, everybody, we'll be right back, but first, a word from our sponsors.
All right, if you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA-registered SIPC-insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted. Get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description.
All right, let's circle back. We got a question here from Brian Anderson, right?
Yeah. Brian asks, hey guys, enjoy the pod. I have a question about when to bail on an idea. And this is timely, Jason, because we were just talking about this stock the other day offline. Take QuantumScape, for instance. The amount of pivoting they've done the last 2 years has bordered on chaos. Their schedule keeps slipping. The original timeline for the joint venture was to produce cells in 2024. So I'm not going to read this whole email because it's kind of long, but basically Brian lays out the bear case for QuantumScape. But then he says, in general, what signs do you look for when to pull the ripcord on an investment? And maybe more specifically towards QuantumScape, what would you need to see at this point to bail? So it's about QuantumScape, and we can certainly dive into that stock as an example. But I like the larger question of when do you bail? When do you bail on an idea? It ties exactly what we were just talking about, like the stocks that sit at the bottom of your portfolio, but maybe sometime later they'll turn it around. So I know you follow QuantumScape pretty closely, so you can dive into the stock, and then we can talk more generally about the question in a more general way.
Probably my favorite thing about this question is it's such a wonderful example of what makes a market. I want to start there because Brian and I have very different perspectives on what's going on with QuantumScape, which I just think is just wholly interesting, and engaging in people that have a wildly different view on a business, I think is really, really and operating from the same information. That's the beautiful thing about the market to me. It's one of the things that makes it so hard is you can have two very smart people. I'm assuming Brian's smart.
Well, I think the bigger
shut,
assumption is that you are.
Hey, thought you keep your mouth shut, but no. So, but no, that's fair. That's fair. But again, the point is that it's wild how we can come to different conclusions, and from the same source. And again, we could use the backdrop of QuantumScape here. I think it's a good idea. So I could talk about QuantumScape and like my broad thoughts as well before you circle in, and that. Initially, when QuantumScape went public, they did have some pretty ambitious goals, and they have pushed things a little bit further down the development pipeline.
And just real quick, QuantumScape is a solid state battery company, ticker symbol QS.
Yeah. So this is big time in the news right now because we're hearing a lot of companies talking about solid state and it coming closer and closer to commercialization. I'll talk about that in a minute too, because this ain't the first time we've heard this before. But again, it's a pre-commercial company. They don't have a commercial product. They're getting really, really close. So solid state's the holy grail, especially for EVs, because it's lighter, they charge faster, better range, more reliable, less fire, just safer, like all the things that are challenging with current battery technology. They address basically all of them. And chances are, because of the materials, if we can figure out the manufacturing part, then the costs will make sense too. So needless to say, the company or companies that get to commercial with solid state are going to be in a wonderful, wonderful financial positions to be able to monetize that, because all the automakers are going to need it if they want to compete in EVs. So back to the key thing. So QuantumScape, when it went public, some of its initial timelines were wildly optimistic, and they pushed back on a lot of those things. But if you look at the past couple of years, it seems like they've largely delivered pretty much within when they were saying they would reach different milestones. And those milestones are getting samples to OEMs so they can get some third-party feedback on the samples. Some of the samples seem like they performed better than expected. And again, it's one thing when they've got their internally tested samples and they say they're great. Of course, they're going to say they're great. They're going to highlight all the great things and not tell us the problems. But when the OEMs are giving them their data, they're not going to just stand by and QuantumScape just say positive or not true things and not call them out on it, right? It looks like the product is really high quality. better than expected on a couple of benchmarks. The challenge for the entire industry is being able to manufacture these things. It's more complex and far more challenging than the lithium batteries, the liquid-based and gel-based liquid batteries versus solid state. It's a lot closer to to like manufacturing solid state memory or semiconductors than it is manufacturing a battery. The precision manufacturing is far higher. So he mentioned a couple of technologies, Cobra and Raptor. Raptor seems like it was just like a step in their process. And I think Cobra is the first process that's going to be able to get them some level of commercial production. So it seems. They also have never been 100% married to whether they were going to do all the manufacturing or if there was going to be some licensing. My view is not that they've pivoted on that, is that they're doing the smart thing and they're doing the JV with Volkswagen, which is a licensing deal that's not exclusive, that's going to get some cash flow. It's going to get some revenue coming in from royalties and put a lot of the capital commitments onto to VW. So I think that's a smart step. Prove it, get the product out there, make some money. All of a sudden, the capital markets are going to be a lot more interested in funding you. Stock price go up, debt markets get more amenable, and then you can start thinking about doing your own manufacturing and getting the whole margin dollar instead of just a slice of the pie. So that's my perspective. And then you look at the whole thing with their CEO, who's the founder of the business, and it's true. He's out, was pushed, moved from CEO to chairman, and then chairman's out the door relatively quickly. And this was somebody who was an academic that developed this technology, a scientist, I think at Stanford. And it does look like investors maybe kind of had a role with kind of helping pushing him out the door as they brought in some precision manufacturing people to run the business. And it is a little strange that his exit happened where they are in their pre-commercial phase here. Typically, they keep those folks around to get the full benefit of the commercialization. So it does raise some questions. But to me, it seems like more of a disagreement between the founder and some of the major investors on who they wanted to run the business. That's what it strikes me as, and not somebody that's cashing out before the business fails, right? I don't think that's the case at all. So again, two people with very different views, and that's what makes the market. But I want to point out that one thing we never talked about there, Jeff, in terms of the process, we never talked about the stock price, right? It was entirely focused on the business results. But it's the hardest thing because they can always give you hope. They can always give you hope.
Well, that's what's hard about this, because when you read the question, which I skipped through, but basically it's like the timelines keep changing. The CEO left and is dumping stock and unfollowed them on social media. And Brian goes on to say any one of these individually could be a red flag. And I think he's right. And I think this is the hard thing. This is why we talk so much about knowing why you own a business and having a thesis for owning it. So if your thesis for QuantumScape was, I believe in this management team, especially this founder, and I believe in their ability to do what they say they're going to do with no delay, then I could understand being like, I'm out. They've betrayed my trust. My thesis is broken. But if that wasn't, if your thesis is just basically like, this is the future, we are going to get to solid state batteries, I think they're going to be a big player, and maybe you hang on. But again, we don't know Brian's situation either. Is this a tiny position? Is this a huge position? Did he go all in? Is he just testing the waters?
Well, and reaching different conclusions is perfectly reasonable depending on those factors and other factors and how you invest and the level of discipline that you invest with.
And being aware of both sides of the coin, right? So, we've now heard Brian's side of the story. I hope he listens and hears your side of it. And maybe you have some countervailing information in your head now, and he does too, to just help make those decisions. The other thing I would say is, especially for a company like this, let's say you're Brian and Brian says, you know what, I listened to Jason, he made a compelling point, but I'm still uncomfortable. There's too many red flags. I'm out. What I would encourage someone in that situation to do is, fine, that's your decision. I get it. Follow the company after you sell, because if they actually do get this together and commercialize it, I'm pretty sure you could probably buy back in later and still be okay from an investment standpoint, right?
Yeah,
This seems like if they commercialize this, it's just going to be like inning one of a long baseball game. So that's, and just look at all the mega cap companies now, the biggest companies in the market. You could have bought them at almost any point from their IPO to now and done pretty well. So if this is the next big thing, there's plenty of opportunity to get back on that train, but you have to keep
Yeah.
got to keep track of what's going on.
No, I think that's right.
And that would be an argument, again, if it's not too big of a position, that would be an argument for hanging on and just waiting and seeing, right? Yeah. There's no real answer to his question, but those are the things I think to be thinking about.
And this is one of the situations where it's a reminder that as much as we love the founder-led business and we look at the Jeff Bezos and Netflix's founder,
Reed Hastings.
Yeah, thank you, Reed Hastings, and the amount of time that Microsoft had multiple founders involved for decades at the business. But sometimes we forget how rare those companies really are, right? I mean, those are the top of the mountain companies, but they're extremely, extremely rare because it's the extremely rare individual that can go from the idea that gets funded to successful IPO to profitable business to taking market share to 30 years later, and it's created billions of dollars of wealth for millions of people, right? Those are extremely, extremely rare. What's far more often is you see successful companies where they were started by somebody who had a great recipe for a cake, but they had no idea how to run a cake manufacturing factory. And I think maybe that's the case for a QuantumScape, is somebody that had the idea for the process for how to make a solid state battery with the right separator and all of that. But then the hard work is precision manufacturing, right? And the skill sets don't necessarily translate. So we're going to find out who's right or wrong. And here's the thing about it. We could both be right and we could both be wrong for completely different reasons. So only time's going to really tell that. So great question, great thought exercise.
All right. Last question we got from Miles, who says, love the podcast, guys. My request is, can you please look at the Calamus ETFs where you can protect yourself on the downside, but limit the upside as an alternative to CDs or money market accounts to park cash in? I don't see a downside if you park the S&P or NASDAQ 100 ETF, as they would seemingly earn more than a short-term instrument. Appreciate the hard work and entertainment value. Always a fun and informative listen. Take care. Thank you, Miles, and thank you for the question.
So I just want to say, hard work. Thanks for the hard work.
Yeah, I don't know how much hard work we put in.
No, none. Zero whatsoever. So, but no, Miles Standish, thank you for this. Thank you for this question. We work hard, just about as real as that name is. So we took a look at the Calamus ETFs, and the short version is that I'm assuming they probably use some option strategies for the way that they invest. So they kind of lock in a range of return for these products. And basically the way they work is you're picking, it has to be options because you buy different ones based on specific months. So you can lock in a particular period of time benchmarked against a particular asset class. So like QQQ, which is the NASDAQ 100 or the S&P 500 index, you can do all these different things. And you get a range of outcomes that's going to be directionally tied to what the market does. So here's the short answer to that question about, does this make more sense than cash, holding cash for that period? And it really depends on how much cash and how much risk and what are you looking at that cash to do with in a year. So looking at the March dated fund, it's the CPNM is the ticker. It's the NASDAQ 100 Structured Alt Protection ETF March. So March of next year, I'm assuming the outcome period is 339 days. So it might be, maybe I guess the beginning of March. So here's the outcome range for this. The current cap is 8.31%, which means the maximum gains that you could get are capped at 8.31%.
Right. So if the market goes up 60%, you're getting 8.13%.
Well, again, maybe. I'm sure there's a range of outcomes you get based on a percentage of what
I'm saying the most you can get.
Right. That's the most you can get,
right,
is 8.31% in gains. Now, that's better than cash, better than the yield you could get on short-term treasuries. Now, here's where the downside is. What they call their current protection level is 100.14%. Means that if the market underperforms, and again, there's that range of the market being up between 0 and 8.31%, that's going to affect what your return is going to be. It's going to be less than that. And if the market loses money, you're guaranteed to get at least a 0.14% gain.
So when they say downside protected, they just mean like basically you're protected from coming out with less money than you went in with.
Your cost basis, right? Your
Right.
investment is protected. A couple things. I don't know how or if there's any sort of insurance-backed guarantee, right? Again, bank deposits are FDIC guaranteed. Treasuries, full faith and backing of the United States government, they're not saying that this is completely guaranteed, right? They're saying that it's protected, right? So capital protection is, well, what's the quality of the business backing it up, I guess is the point to that. I wanted to stress that. But are you investing that money for a guaranteed yield, or are you just trying to get a little bit more? So again, the difference over 1 year between 4%, which is what you can get on a treasury right now, and 8% is not a lot of money if it's a few $1,000s. If it's a few $100,000, that's a pretty decent amount of money. But are you stepping past that 4% yield that you could really use in a year, right? Or is this simply part of how you're hedging your cash inside of your portfolio? And then, of course, the flip side of that is that cash, one of the great values of cash is it's immediately available. When you're investing in these particular instruments, again, I'm assuming there's probably they're ETFs, so there's probably some market volatility from day to day. I don't know exactly what the outcome looks like for there.
Right. Yeah. And two other things, right? This is an ETF with a expense ratio of 0.69%, which is on the higher side for an ETF, right? You can get a regular S&P 500 or NASDAQ ETF for less than that. And remember too, if you buy this and then sell it because you need the cash and it's up when you sell it, you're going to pay short-term capital gains taxes on that sale, right? So there's that to factor in too. I can see why these are attractive, Jason, and I don't necessarily think that there's a problem in investing in these as long as you are completely clear-eyed as to what you're investing in. But to me, if it were me, I wouldn't be interested because I would rather have stocks or ETFs that track the stock market, right? Like VOO, the Vanguard S&P 500 ETF, to capture all of the potential upside. And then I'd prefer to have cash, CDs, short-term treasuries, bonds to lock in some safer, more guaranteed yield, right? This seems like a shortcut to doing the work of having both ends of the spectrum out there with some questionable other aspects like that you just talked through. So yeah, I stay away from weird stuff like this just because I feel like it's overly complicated for no reason, even though it seems like a simple solution. But I think as long as you know what you're getting into, taking some money and putting it in something like this, as long as you know what you're getting into, I don't think it's a terrible thing to try.
One more thing to think about too, looking at liquidity is another thing to remember. So it's an ETF and it's only available on certain brokerages. I know Fidelity and Schwab, you can buy from there, but sometimes liquidity is an issue. So even though you do have the ability to buy it and sell it on the market, I think this particular one, there's 225,000 shares outstanding. That's not much. So again, just be aware of all of those factors that can come into play and whether those things might undermine what your actual goals are. Like if you prioritize flexibility of being able to turn that investment into money quickly, it could be limited. So just think through all of those implications before using any of these kind of more obscure instruments. So
yeah,
that's it, right?
The average volume is 35,456 shares.
Yeah. That's not nothing. I mean, that's probably sufficient for most people, but again, just your mileage may vary.
All right. Well, we did it. We answered all of the questions we had for the mailbag, the March 2025 mailbag in April because of February.
Correct. Yes. The full name. All right, Jeff, this was a great time. As always, just remember everybody, these are our answers. We love giving them. You love listening to them, but they're not your answers unless you really try them on and own them and make them your answers. But the point is that it is up to you to find your own answers to these hard questions about investing and finance. I believe in you guys and girls, people, all you people. I don't want to gender anybody or misgender them. Let me start over. I believe in all of you, each and every one of you. All right, Jeff, we'll see you next time.
See you next time.